Good afternoon, everybody, and welcome to James Cooper Creston's webinar talking about solvent liquidations. I have with me one of our three partners that undertake solvent liquidations, Sandra Mundy. Hello, Sandra.
Hello, Andy.
And throughout the presentation, we're going to do it a little bit different. So I've got a number of questions for Sandra, which will help us better understand the benefits of solvent liquidation. For those of you who have attended these webinars before, you will know that you'll be able to ask questions as we go along. And just what I'd quite like to do as well, just make sure that you can all hear us okay. Just want to have a quick poll just to see what is going on. So please tell me, have any of you had the need or opportunity to speak with clients about solvent liquidations in the past year? Okay, good. Well, first things first, it's, you can all hear me, which is great. And actually 50-50. So one of those things that say hopefully that some people will take for today the opportunity to take what we're saying to their clients, but obviously something that is of interest to quite a lot of you at the moment. So as we say, as we go on, please feel free to ask questions. What we'll probably do is look at the questions at the end, because I've obviously got a number to put to Sandra. So let's kick off. So Sandra, so what exactly is a solvent liquidation?
Well, a solvent liquidation, or an MVL, members voluntary liquidation, is the winding up of a company's affairs and the distributing its assets.
And who exactly winds up a company?
Usually it's the directors and shareholders will have spoken to their accountant, their solicitor, their banker, etc. before deciding to liquidate a company. It's technically the directors that recommend to shareholders to liquidate, and those shareholders appoint a liquidator. Once a liquidator is appointed, the liquidator takes control and the director's powers cease.
Okay. So what happens once the liquidator has finished his or her work and paid over a distribution to the shareholders?
Well, at the end of the assignment, the company is dissolved, so the process of liquidation ends the company's life.
Okay. When might someone consider using a solvent liquidation?
Okay, Andy, I quite often see the procedure used when there's been a successful trade or asset sale and owners have retired and there's a pot of cash to distribute to shareholders. The solvent liquidation is useful to shareholders, enabling them to make use of entrepreneurs' relief and potentially paying tax at as little as 10%.
And have I heard something recently about plans to limit entrepreneurs' relief?
Yeah, you're right, Andy. There's been a consultation recently, although we've not heard the outcome as yet. Essentially, the Chancellor is worried that with the changes to the dividend rules, making it less attractive for higher rate taxpayers to receive dividends, it will increase the prevalence of liquidation followed by phoenixing. So phoenixing is where a company runs for a year or two, then liquidates with the shareholders receiving capital distribution and taking advantage of entrepreneurs' relief, paying, as I said earlier, as little as 10% in tax. In the meantime, another company is set up doing essentially the same thing, and the company is then liquidated within a year or two, taking advantage of the capital distribution again and the entrepreneurs' relief. I think the concern is that this is repeated time and time again, with shareholders only ever paying a reduced rate of tax. And in certain industries, it is already fairly commonplace, such as construction and contracting.
So what is it exactly that our friend Mr. Osborne, the Chancellor, is proposing to do?
As I understand it, the government is planning to bring in new targeted anti-avoidance rules to apply to distributions from solvent liquidations. For solvent liquidations after the 5th of April this year, distributions will be treated as income as opposed to capital if within 2 years phoenixing occurs, or the main purpose of the liquidation, or one of the main purposes of the liquidation, was to obtain a tax advantage. But there's still time to act now if you want to liquidate a company ahead of this likely rule change, but you'll need to act fast.
So what should people do if they want to get in ahead of the rule change?
Well, I would suggest that they'd ring me directly after this presentation, as we'll need some time to plan a liquidation.
Okay, thank you. So other than after a sale or retirement, when else might someone contemplate using solvent liquidation?
There are a few other circumstances when a solvent liquidation is commonly used. For example, in preparation for a sale, a business might want to split off one division or some assets so that specific parts of the business can be sold. I also see solvent liquidation used where there is a shareholder dispute. Sadly, this is more often than not when you've got a husband and wife team who are getting divorced. Sometimes the business is wound down or sold, and the capital needs to be distributed in a tax efficient way. So the alternative might be to split the business in two if possible, so that each shareholder gets their part of the business. And if a solvent liquidation is used to achieve this, then it's broadly tax neutral.
Okay, cool. And any other times when you might consider using a solvent liquidation?
Sometimes you use it to reduce the burden and cost of annual compliance, especially where you've got a large group. Commonly, dormant companies can be struck off, but watch out for any assets that might remain after the entity's been struck off, because these will become property of the Crown. In the past, I've been asked to restore a company to the register and then liquidate it. In this instance, the directors overlooked the cash at bank of some 200,000 before strike off.
An expensive oversight.
Yeah, you're right. I would recommend considering an MVL where the company has in the past employed people. There may be some ongoing risks such as asbestos related claims, especially in the building industry, or where possibly the company has a lease liability that might have some ongoing risks associated with it. There is another potential for saving in terms of costs here for a company that liquidates after its year end, but before the filing deadline for its accounts. Because after a resolution to liquidate has been passed, Companies House will no longer accept accounts, and therefore the cost of preparing statutory accounts can be saved. However, you should be aware that you will need to have some tax sufficient for agreeing the taxation position.
Sandra, the slide says something about skeletons now, so I think I've got a few of those, but we won't go into that now. What are you actually referring to here?
Okay, I say this with some trepidation, but there are some cases that I've seen where the current management team don't have full knowledge of the past trading history. One particular company I'm thinking of here operated in the building industry. The company had been in operation for some 100 years and had received a claim from a former employee for an asbestos-related illness. On investigation, the management team couldn't find insurance certificates of the relevant years. Indeed, they were missing insurance certificates for about 2 to 3 years in the relevant period. Although the company thought it did have insurance, but just couldn't find the certificates. The company paid out that asbestos claim, but were concerned that there were other potential claimants out there that might arise. The company's trading performance was also declining, and shareholders had been considering for some time closing the business. The company looked into obtaining an insurance policy to cover the asbestos risk, but because there were only minimal employee records from about 50 years ago, it was difficult for the insurers to quantify the risk. The company was liquidated, and as liquidator I advertised widely for claims. The Insolvency Act provides that once a period of 21 days or more has elapsed without any claims being received, then the liquidator may distribute funds to shareholders without any taint of any creditor claim. In this case, no other claimants came forward, and the shareholders received dividends untainted from any further employee claims. Clearly, shareholders must only proceed with extreme caution in those sort of circumstances, and it may also throw up claims that otherwise wouldn't have been made, and you must be careful not to be seen just to be trying to avoid claims. I would recommend that shareholders take not only my advice but legal advice before embarking on this route.
Indeed, thank you. Is there an alternative to liquidation?
Yes, lots of companies are struck off. But as I was saying earlier, all the assets and liabilities need to be dealt with prior to that strike-off. HM Revenue and Customs used to allow businesses to be wound down without a need for a liquidator to distribute the surplus funds to shareholders. And HMRC would treat the surplus as a capital distribution rather than income for tax purposes, attracting a lower rate of tax. And some people might remember that was called the Extra Statutory Concession C16. This was replaced in 2012 by legislation which was less generous, capping the amount that can be distributed in anticipation of a company dissolution treated as capital rather than income at £25,000. This relief is now, however, automatic rather than needing to be applied for. It's worth noting that if the distribution is over 25,000, then the whole amount will need to be treated as dividend income, which would be a significant disadvantage for higher rate taxpayers. For most shareholders who are higher rate taxpayers, it's likely that the cost of winding up the company at the end of its life would be less than the tax benefit of placing it into a solvent liquidation. The removal of the extra statutory concession has seen a huge rise in the number of solvent liquidations that us insolvency practitioners do and have undertaken in recent years.
You've spoken quite a bit about the tax efficiency of a solvent liquidation. Can you go into a little bit more detail on that?
Yeah, of course. Distributions are treated as capital rather than income for tax purposes. And with entrepreneurs' relief, the tax rate could be as little as 10% compared to a higher rate taxpayer who will pay tax on dividends at 32.5%. In addition, capital distributions can be made either side of the tax year so as to use up annual allowances, which for 2015-16 is £11,100. So for a husband and wife team owning a company on a 50-50 basis, they could, between them, extract £44,000 tax-free simply by the liquidator making a distribution just a few days apart.
What stops people just distributing their reserves out without the need for a liquidation?
Well, other than tax efficiency points, shareholders need to also be aware that there are some reserves that are not distributable without a liquidation. Other than a liquidation, a company cannot distribute its share capital or undistributable reserves. So undistributable reserves might include any share premium account and the capital redemption reserve, and any other reserves that the company is prohibited from distributing by statute or by its own memorandum and articles.
And what happens if a company does make such a distribution?
Well, it's classified as an illegal distribution to shareholders. The shareholders would then become liable to repay those funds to the company, and on a dissolution, such a debtor would be property of the Crown. Although, since the introduction of the capital reduction scheme, the Treasury Solicitor has indicated that he will not seek to recover those funds.
Okay. Earlier you were speaking about splitting a company to prepare it for sale or to resolve a shareholder dispute. Is that more difficult than a normal solvent liquidation?
Yeah, it's slightly more difficult, Andy. It's known as a Section 110 reconstruction or a demerger. It might be used where someone wants to extract a property, for example, from the company before selling the business or giving it to the next generation, or maybe even hiving off a volatile part of the business. You need to be careful there to make sure that both entities remain solvent after the process. Or it can be used as a method of splitting up a company once shareholders have fallen out, as we were saying earlier.
Yeah. Why can't you do this outside of a liquidation?
The problem with trying to do such a reconstruction outside of a liquidation is that the disposal by a company of part of its business could give rise to a chargeable gain for corporation tax purposes. This tax is assessable on the company. Then also, when the proceeds are paid to the shareholders as dividends, a further tax will be assessed on the shareholders. With a 110 reconstruction, because tax clearance is obtained in advance, it's broadly tax neutral.
Okay. So I've taken advice, I've come to see you, and we've decided that I want to put my company into liquidation. How easy is it?
Well, it's generally straightforward and can be implemented very quickly, Andy, you'll be pleased to hear. Prior to the liquidation, James Cooper Creston will work with the directors and shareholders and their advisors to provide the necessary documents, and those will include an engagement letter and those dreaded anti-money laundering checks, as we all love and know. Then there's the directors' minutes recommending to the shareholders to liquidate and a declaration of solvency. In order to be able to produce a declaration of solvency, I'll need a current balance sheet. In addition, I'll have some questions, I'm sure, about sort of things that don't necessarily appear on the balance sheet, such as supplier termination clauses, sometimes leases, and pension provisions, etc. And we can then prepare the declaration of solvency for the directors to review. Directors should be very careful with their review, because if they swear a declaration of solvency without having reasonable grounds for the opinion that the company will be able to pay its debts in full, together with statutory interest, which to note is 8% at the moment, whether they're liable for an imprisonment or a fine or both. I've never seen it applied, thankfully. However, I don't want any of my clients to be a first. So once a declaration of solvency has been sworn, it's for the members then to resolve to liquidate the company. The members can do this at a meeting or, if preferred, by written resolution. It's a shareholder's choice, but there's a little bit of a cost saving if they do it as a written resolution. And then once that's happened, I then make an advertisement in the London Gazette and ask for creditors' claims, as we were talking about earlier. needs to only be in the London Gazette, but we will always indicate in bold type at the bottom of the advertisement that it is indeed a solvent liquidation, so there can be no confusion. Advertising more widely in some circumstances where they're suspected creditors but their location is unknown. So for instance, the asbestos sufferers, we advertised in a national newspaper on that occasion.
Okay. Earlier we were talking about having to wait for 21 days for any potential creditors to come forward prior to making a distribution to creditors. Is there any way of speeding this up?
You're right. Creditors have a statutory minimum of 21 days to make a claim, and then after that the liquidator may distribute the remaining funds to shareholders without any further claims having to be dealt with in the liquidation. However, there are situations where it's not anticipated that there will be any significant creditors that come out and the shareholders are prepared to indemnify the liquidators. Then a distribution can be made immediately on the appointment of liquidators. So to facilitate such quick payments of funds, we usually ask that those funds are lodged with James Cooper Creston ahead of passing the resolution to liquidate. In my experience, if funds aren't lodged with us ahead of liquidation, it can take the company's bankers quite some time to recognise the appointment of liquidators, and they essentially freeze the bank account, and indeed the directors no longer have powers to authorise such payments, so you can end up in a bit of a stalemate situation with the distribution being delayed.
Of course. So bearing in mind shareholders might want to take advantage of their annual capital gains tax allowance, if they're thinking of liquidating their company, when should they contact you?
Well, as soon as possible, really, Andy. To make a distribution ahead of the 5th of April and a few days later, the shareholders will also need to start to plan now. Don't forget that a married couple with a 50-50 shareholding could receive 44,000 tax-free in this calendar year.
Okay. You've spoken quite a lot about cash distribution, but what happens if shareholders want to receive a physical asset? Can you do this in liquidation?
Yeah, it's not a problem. Liquidators can distribute assets in specie. Where a distribution in specie is made, there needs to be an agreement to the value of the asset being distributed such that other shareholders receive appropriate recompense, and also that any tax payable by recipients can be calculated. I've distributed all sorts of things from a property to 6 pet cows. So yeah, pretty much anything can be distributed in specie.
And what happens once the liquidator has paid creditors, finalised the tax position, and has paid the shareholders?
Well, tax clearance can take a bit of a time, but once this has been received, then the liquidator will call a final meeting. No need to attend, actually. I sit there quite often on my own at meetings. It's really rather sad. But then after that meeting, the liquidator ceases to act, and then 3 months after that, the company's dissolved at Companies House.
Should shareholders ever worry about the stigma of liquidating a company?
No, there should be no reputational risk associated with the solvent liquidation at all. After all, the directors and shareholders have been successful, and a solvent liquidation should just be viewed as the mechanism to extract their investment in the company. We are required to advertise the liquidation in the London Gazette, but we always note, as I said earlier, in bold letters that it's a solvent liquidation. A solvent liquidation also should have no adverse impact on credit ratings of directors or the shareholders. The liquidator does not undertake any investigation into directors' conduct, and therefore there are no concerns about directors' disqualification, etc. There's also no restriction on trading going forward.
Okay. So there's a few of you out there. How should you choose who to liquidate your company?
Well, I think there are a number of factors that you should consider, including trust, speed, quality and cost.
And what factors do you think someone should bear in mind regarding the trust issue?
Well, I think people should do their homework, really. Is it really as simple as searching on the internet for the lowest price? I mean, I'd suggest that wasn't a great idea when somebody's potentially liquidating a company that's been their life's work. Remember that on passing the resolution to liquidate, the director's powers cease and the liquidator has sole responsibility and control. Whilst all insolvency practitioners are qualified and they're required to hold an insurance bond and professional indemnity insurance, I would still want to either know the insolvency practitioner personally or have a recommendation from a trusted advisor.
And in terms of speed, how quickly can this be done?
Well, with some careful pre-planning and the indemnities from the shareholders, distributions can be made on the same day as the shareholders resolve to liquidate the company.
And cost?
Well, there are a number of charging mechanisms in the Insolvency Act. There's fixed fee, there's time costs, or there's a combination of both. We typically undertake liquidations from about £4,500, but clearly the greater the complexity, the more the cost. There are also some disbursements that the shareholders should be aware of, with the highest one of which is bonding. Bonding is in bands. Because we are a larger practice, take advantage of lower rates than a smaller insolvency practitioner might have. There'll be some advertising costs, be some VAT. If the company's ever been VAT registered, even if it currently isn't, we can usually recover that VAT. But there's also some stuff that the directors and shareholders can do to control the costs. So if they were to pay all creditors ahead of liquidation, they save the 8% statutory interest that they would otherwise have to pay, and of course they don't have to pay for the cost of the liquidator making those distributions to creditors. They also need to make sure that the company's books and records are accurate and up to date, and that any tax returns that can be completed have been completed. Again, of course, that will save on costs. Then there's a little bit of a strange one that we've come across on time to time. There's sometimes contracts in the company that the directors or shareholders actually want in their personal names for things like mobile phones. So arranging for that to be transferred prior to liquidation is not only cost effective, but it also reduces a lot of potential hassle in the future.
Sure, thank you. Well, and any other professionals need to be involved in this process?
The tax affairs will normally be brought up to date, so the liquidator will work with the company's accountants to make sure that the necessary returns are done. In some cases, particularly in the Section 110 reconstruction stroke demerger, a solicitor will be involved to prepare the Section 110 agreement. Often companies will engage a specialist to do this, as this work is quite specialised and it can save on costs in the long run.
Okay, so the million-dollar question: why should someone consider using James Cooper Creston to liquidate their company?
Well, we have 3 licensed insolvency practitioners supported by 2 senior managers who are also qualified insolvency practitioners. In addition, to the senior manager, we also have a qualified team to support us. We have a strong reputation in dealing with solvent liquidation, and we've distributed over 100 million of cash to shareholders in recent years, acting on about 90 liquidations. We're often able to provide that same day distribution to shareholders, as I was talking about earlier, and we can help with written resolutions and electronic communications if shareholders don't actually physically want to meet. They're cost-effective liquidations from £4,500 plus VAT and disbursements. Together with, I'll offer discounts if there's multiple assignments.
Why go anywhere else? Really,
absolutely.
Isn't it? Sandra, thank you so much for that canter through solvent liquidations. I've kind of finished all my questioning now, but if there are any questions from the attendees, then more than happy to sort of take those at this point in time. Just wondering whether, having heard the uses of a solvent liquidation, whether you actually think that over the next 12 months you're now in a position to either lightly speak with clients about sort of going through that solvent liquidation process. So we just launched a poll just to see whether or not, look at that, all of you. Fantastic. We actually
oh, there's one.
No, see, there's always one killjoy, isn't there? But I think it's so definitely as we sort of say, it's very much one of those things that is worth talking to clients and potential clients about. We are very much here to help you and to assist you. Contact details are on screen. Sandra, very much the expert. Please don't ask me any questions. You're not going to get anywhere with that. And would just like to draw your information to the disclaimer at the bottom of this slide. I mean, the webinar was very much just for information. Please do not take it as giving sufficient advice in any case. If there is anything that we can help you with, then please do contact Sandra. No questions, so that means we must have covered everything within this presentation. Sandra, thank you so much.
And thank you, Andy.
And just like to thank the team here for pulling this together, and to thank you all for attending. So if there's anything that you need to know prior to this, or after this presentation, please do contact us. We will be sending you a copy of the presentation and the recording for you to listen to in your own time. So thank you all once again for attending, and we look forward to talking at you again at another webinar very soon. Thank you so much.
Thank you. Bye-bye.
Bye-bye.